Uh, Good morning. It's an honor to be here today. Today, I'd like to tell you about one of our favorite investment ideas. However, before I do so, I'd like to tell you just a bit more about the firm that I run, 3G Capital. First off, some disclosures. Uh, so here's some brief background information about 3G Capital. 3G Capital is a private investment partnership that invests in undervalued businesses around the world. Our investment universe includes frontier, emerging, and developed markets. We look to invest in a small collection of industry-leading businesses at single-digit multiples. Our investment focus can be described as looking for good businesses managed by good managers and available at a good price. We've been in business since 2004, and in the course of our existence, we generated a track record of significant market outperformance versus our benchmark. As you can see here, we generated a compounded annual return of almost 13% versus 7% for the benchmark. Now, since pretty much everybody has a different definition of what a good business means, I'd like to give you a bit more detail as to how we define a good business. So here you can see that for us, a good business means a business that occupies a leading position in its industry, and we tend to stick with industries that have a long-term track record of leadership sustainability, such that the factors behind the leadership sustainability can be easily identified. Lastly, we define a good business as a business that has little or no debt. When it comes to good management, we'll look for three things. We'll look for operational excellence, capital allocation skill, and interest alignment. Finally, we define a good price as a price of anywhere between 4 to 10 times normalized sustainable earnings. The exact multiple we're willing to pay would depend on the growth profile and the return on capital profile of a business in question. As a practical matter, if you were to look at our portfolio today, you'd see the average P multiple of 7 times, the average dividend yield of 6 times, that compares to 16 times for the benchmark on the P level, and a dividend yield of 3%. Finally, when it comes to portfolio management, we invest in a highly concentrated fashion such that the top 5 positions generally account for anywhere between 60 to 70% of the total portfolio. Up next, I'd like to briefly go over the ideas that I presented here in the past 5 years. So last year, I presented Hinama Lab International, a company of Mexico. This company is a leading provider of personal care and OTC pharmaceutical products across Latin America. Their brands occupy number 1 and number 2 positions across the respective markets. At the time of the presentation, the stock was selling for about 5 times earnings, and it had a high single-digit dividend yield. So the outcome is the total return since presentation was 50% versus 6% for the benchmark. And back in 2002 here, I presented a company called Kaspi. It's a super app out of Kazakhstan. Essentially, it's a digital ecosystem spanning fintech, e-commerce, travel, payments. And at the time of the presentation, again, it was selling for about 5 times earnings. It had a low double-digit dividend yield, and since the time of the presentation, the total return on the stock was over 100% versus 16% for the benchmark. And I think we spoke quite a bit about value underperforming in the past 5 years, so I apologize for presenting the disconfirming evidence here. So let's talk about our favorite investment idea. So first off, how do we source investment ideas? So traditionally, what we'd do, we would use what I call a business-first approach. We'd look at a business, and then we would try to analyze the strengths and the weaknesses to see how they factor in the assessment of quality. But I thought there might be a better way to do it. And I actually got inspiration for that from Carl Jacobi, who is a 19th century German mathematician, who is known for saying that you should always invert. And incidentally, Charlie Munger used the exact same approach back in 1996. In his speech, Practical Thought About Practical Thought, he reverse engineered, using that same method, the analytical pathway to find a winning investment in the beverage sector. And what he used is what I call a characteristics first approach. So as opposed to finding a business first, he would try to imagine what an ideal business in a given industry would look like, and then he would try to find anything that would fit the template. So I tried to use the same method to come up with an investment idea. And how do we pick an industry to get started? Well, in his speech, Charlie Munger identified 3 things that an ideal business must have. First off, it should be essential, so it should be needed or desired over the long term. Second, he said that a business must have a universal appeal, such that it operates in a very large market. And lastly, it should be a non-generic business, so that it can grow in the face of competition. So the business that I stumble upon is actually, the industry rather, is travel. Why? Well, it checks all the 3 boxes. So it is essential because it's been around for millennia. It touches every human being, so obviously, universal appeal, large market. And when it comes to being non-generic, there is a part of the travel industry that is non-generic. And that's the part that I decided to stick with, and that part is car rental. So on the following slide, I decided to list the 5 factors that would describe an ideal car rental business. So here are the 5 things. Number 1, the company has to have a reputation for providing superior customer service such that the end users are willing to pay a premium for using its services. Number 2, the company has to have a large network such that it can move vehicles around from the markets where the rates are low to the markets where the rates are high, as to maximize revenue per vehicle. Thirdly, the company has to be astute with buying vehicles and also astute with selling vehicles. So they should be able to get a discount on pricing from the OEMs, and they have to have an efficient vehicle disposal system such that they can price the disposed vehicles at a premium. Fourth, the company has to have the lowest cost of capital in the industry, and that would imply a rock-solid balance sheet. And lastly, the company should be operating in large and growing markets as to enjoy a long growth pathway. So if you were to look at all the 5 factors, attributes 1 through 2, they give you a revenue advantage versus the competition. Factors 3 to 4 give you advantage versus the competition on the cost side. And of course, they combined to give you a return on capital advantage versus the competition. And the 5th factor, it provides for long-term growth in value by applying the superior return on capital to a large growth of capital, to a large amount of capital. And looking around the world, I did manage to identify one such company that would fit the template. And the company is Localiza. The company is based in Belo Horizonte, Brazil. It is the largest company in the country. It operates in very large and growing markets, more specifically in its core market of Brazil, and they also have a nascent business in Mexico. The company possesses a very strong competitive advantage that should enable the company to consolidate its end markets at the expense of less efficient competitors. Localiza possesses a rock-solid balance sheet, and they have an owner-operated management team that has a very strong focus on capital allocation. Finally, the business is available at a highly discounted price of 8 times earnings. So on the following slide, I suggest that we go through the checklist to see how the data on the company lines up with the template for the ideal car rental company. So here, does the company provide superior customer experience such that it can charge a premium for its services compared to the competition? The answer is yes. The company is known for having the best customer experience. If you look at the NPS scores for Localiza, they will be in the range of about 90. If you look at the competition, the NPS scores are probably going to be in the 50 to 70 range. The company has by far the best brand awareness in Brazil and also in parts of Mexico. By way of reference, their brand awareness is 5 times as strong as that of the next biggest competitor and 15 times as strong as the brand awareness for the third largest competitor in Brazil. And as a result of that, they can price the rental services at a 5 to 10% premium to the competition. Second, does the company have a vast network such that it can move vehicles around to where the rates are the highest? Again, the answer is yes. Localiza has about 650 branches around Brazil, which is almost 3 times the size that of the second largest competitor. The third largest competitor only has about 150 branches. So they have a significantly more dense and developed network compared to the competition. Thirdly, is the company astute with buying vehicles and also with selling vehicles? And of course, here the answer is also yes. Localiza is the largest car buyer in Brazil. As a matter of fact, Localiza buys 11.3% of all the cars sold in Brazil. As a result of being the largest buyer of cars in Brazil, they're able to get a 20% discount from the OEMs. And of course, the company's competitors are unable to get anything close to that pricing. In terms of selling cars, the company is also very astute with selling cars. They do so much business volume that they can afford to have their own dealer network. So as opposed to others who are forced to sell their vehicles at wholesale prices, Localiza has its own network of dealership and they can sell at retail prices, which is a 10% premium. So the total fleet carry cost for Localiza is going to be way lower than that of the competition just because they can buy cheaper and sell more expensive. Fourth, does the company possess the lowest cost of capital? Again, the answer is yes, they do, because the company has a rock-solid balance sheet. For reference, their debt to fleet is 50%. The norm in the industry is considered to be about 75%, but many of the company's competitors actually have debt to fleet ratio of 85% and above. And as a result of having a rock-solid balance sheet, the company is able to enjoy a very low cost of capital. I think they pay about 1.5%, and the competition pays about 3.5% to 4%. Finally, does the company operate in large and growing markets? Again, the answer is yes. If you look at Brazil, for example, where the company has 40% market share, the penetration rate of car rental services in Brazil is about 50% compared to the developed markets. When it comes to Mexico, where the company has just a 4% market share, the penetration rate in Mexico is about 3.5%. So huge growth potential on that front. And of course, to be expected, given all of those very substantial and robust competitive advantages, they result in industry-leading KPIs on the financial side. If you look at returns on tangible equity, Localiza generates returns on tangible equity of 20% plus. Operating margins, same thing, 20% plus. The company has 0 net debt if you take out the fleet value. And of course, if you look at the debt ratings, they reflect that. S&P, Fitch, and Moody's, they all rate the company as AAA. Now the company has managed to grow quite a bit over time. They increased their sales 10 times in the past 10 years. And of course, Going forward, it is likely that the company will continue growing at a very brisk pace. Looking at the company's main markets, Brazil only has 3,500 rental vehicles per 1 million population compared to 7,000 in the US. And then in Mexico, that figure is even lower. In Mexico, they only have 250 rental vehicles per 1 million population compared to 7,000 in the US. And in that market, Localiza has just a 4% market share, so very substantial growth potential. Now that we covered business, let's review the company's management. As I told you before, we look for three things when it comes to management. We'll look at operational excellence, capital allocation skill, and interest alignment. So if you look at operational excellence, the company's CEO, Bruno Lisansky, who joined the executive team in 2016, has a great track record of running the business. Look no further than the operating metrics for revenues and operating income since the time. Since 2016, the company has grown revenues from 4.5 billion reais to 37 billion reais. Over the same period, the company increased operating income from 750 million reais to over 6 billion reais. When it comes to allocating capital, the management team is just as good. They actually have a very robust decision-making process, which is highly rational and data-driven. Anytime they look to reinvest back in the core business, they compare the yield that they get on the fleet versus the earnings yield on the stock, and they just allocate capital to the higher yielding alternative. One other thing to note is that a lot of the company's competitors, they ended up investing in non-core businesses, and unlike the competition, Localiza stayed laser-like focused on the core business of renting cars. Finally, in terms of interest alignment, the chairman founder of the company, Eugenio Matar, owns a 5% stake in the business. Lastly, let's talk about pricing. No matter how good a business is and no matter how good a management team is, if the pricing is not right, the return is probably not going to be great. However, in terms of Localiza, the pricing is highly attractive. If you look at the stock today, the P/E ratio on the forward number is 8 times. The total economic value to operating earnings is 6 times. It's a 5% dividend yield. If you look at the historical average P/E for Localiza, it's been over 20 times. If you look at the valuations for the company's competitors, they're anywhere between 10 and 26 times operating total economic value to operating income. And finally, MSCI World Index trades at about 20 times. So however you slice it, it appears that Localiza is selling at a highly attractive price. Of course, no discussion of a business is ever complete without going over the risks. So here I identified 4 main risks that the company faces. First off, technology-driven disruption. So you have your ride-hailing and car sharing. Is that a risk? As you look at it, probably not, because companies such as Uber in ride-hailing and companies such as Turo in car sharing, they operate at an inherent cost disadvantage compared to Localiza. If you think about it, with Uber, you just have a lot of individual drivers or maybe smaller organizations that are present on the platform. So they don't necessarily have the buying power to be able to get a great discount from the OEMs, and they don't have the disposal network to be able to get good prices for the vehicles that they sell. Further, they don't have the scale to be able to service those vehicles efficiently. And therefore, in terms of cost, they're always going to be behind Localiza. Furthermore, specifically with respect to Uber, you're always going to have a cost of a driver, and you're also going to have a cost of a platform. So cost-wise, you're just never going to be able to match the cost that Localiza has. Therefore, you're always going to be losing that competitive battle, at least in the sort of multiple trip category. Another technology-driven threat is companies such as Waymo that provide autonomous driving technology. Again, I don't believe that's a competitive threat because those companies are interested in selling technology to someone rather than saying, well, we're going to invest significant amounts of capital into fleet, and then we're going to invest significant amount of capital in servicing that fleet. Second, currency risk. Obviously, we're US dollar investors, so we have to make sure that we're not at risk of local currency depreciation, reducing our return beyond acceptable figures. And if you look at the business, what you see is that historically, Localiza has been able to pass the negative impact of local currency depreciation onto the end user by adjusting pricing. And of course, the evidence is in the numbers. If you look at what happened in the past 10 years with respect to US dollar revenues, Localiza was able to grow those US dollar revenues by the factor of 5, or actually more than that. And that's despite the fact that the Brazilian real depreciated by a factor of almost 2. Finally, corporate governance. Anytime I try to assess corporate governance, I look at 2 things. I look at the operational performance, and what I'd like to see companies monetizing their competitive position to the full extent, because that would suggest that there are no value leaks. And it is the case with Localiza. If you look at the operating profitability, it is definitely going to be best in class. So obviously no value leak there. So they monetize the competitive position fully. Second, we assess capital allocation skill of the management team. And here again, I would say that's not a risk because the company has a track record of returning excess capital to the shareholders to the extent that internal reinvestment opportunities are just not attractive. Finally, geopolitical risk. Again, I don't think it's very high with respect to Localiza. Brazil is actually aligned with the West quite tightly. So I can't really imagine seeing a major strategic geopolitical conflict to such that is just so major that it leads to permanent capital loss for businesses based in Brazil. So that concludes my presentation, and now I'm happy to take whatever questions you might have.
Okay, thank you. 1 second, pause.
Thank you for the presentation, Pavel. Great company that you bring us today. A short question. Well, I have a few questions, but one that I wanted to ask you is, do you know if they have in mind a company they look up to, or have you researched a company, similar company in the US or in Europe?
Actually, I looked at a lot of car rental companies in both in the US and in Europe. Like I looked at Enterprise. I know people who run Enterprise. I talked to them about Localiza. I've looked at like Hertz, Avis in the US as well. Looked at Sixt. I wouldn't say that Localiza necessarily looks up to any of them. If anything, I would say that they should be looking up to Localiza, because what Localiza managed to do in Brazil, they operated in a market that is known for being a very harsh market from a regulatory perspective, and they made it work. And now they went into Mexico, which is the market very similar to Brazil in terms of being a tough market to operate in. And for that reason, the competition does not want to be in Mexico. But Localiza said, look, we have that track record in Brazil. We went through the exact same problems, so we can figure it out in Mexico. And they got into that market. And so far, their operating metrics in Mexico are like well ahead of the competition.
And just second question about the Net Promoter Score. You said that the company has around 50 to 70?
No, it's like close to 90.
Close to 90?
90, yeah.
Okay. Do you know if the sales people have incentives linked to NPS?
Well, I don't specifically know if the salespeople have incentive tied to like customer satisfaction, but I would imagine there's got to be some kind of system that ties their compensation to customer satisfaction. Again, like I don't know specifically, but I do know that like in terms of technology and ease of use and billing, they're like way ahead of the competition. Just to give you an example, they have this technology called Localiza Fast, and with that technology, you can be in and out of the branch with your vehicle in hand in less than 20 minutes. And when it comes to like Movida, which is number two, it's probably going to take you 40 minutes. That's just one data point. Another data point is that, for example, if there is, billing, they make it super convenient. There are like fewer errors. Again, with like the number two, three, or four players such as Unidos or Movida, what that billing is going to be out of whack a lot of times. It's just hard for them to fix it. So just a lot less convenient. And that's precisely why consumers are saying, look, I'd rather pay 10% or more for renting a vehicle from Localiza because I know it's going to be like no trouble with somebody else. Who knows? Like you show up at the branch, the vehicle is not there. You show up at the branch, and then there's a huge lineup, and then it takes you an hour.
Thank you. Thank you, Pavel.
Sure.
Thank you. So, hi, here, to the right.
Okay. Very confused.
Thanks for the presentation. It looks like an interesting company. I just took a glimpse into the financials, and I saw that they had a pretty sizable deal in 2022. It was either a merger or an acquisition, buying Unidas.
Yes.
Yeah.
Yes.
And I saw that they also, in the terms of the deal, was that they had to dispose some assets to Brookfield, so to a company managed by Brookfield Asset Management.
Yeah, which is Unidas. That's the number
that's
three.
Unidas.
Yeah. 'Cause
Okay.
it was just for competitive reasons.
Okay. And how do you see that? Did that somehow shake up the competitive landscape, or did that lead to a better market position, or perhaps, I don't know, my intention is maybe it helped to capitalize another competitor which may pose a threat in the future?
Look, I mean, it made the company's competitive position a little bit stronger because you were number one, but you had like a close second, and then you took out the close second, and now you're sort of like in the lead. Like I said, you have 650 branches, and that's sort of a rump of a company which had to be disposed that you referred to, like that's like 150 branches. So you're like 4 times the size. So obviously in terms of pricing power and scale, like you just have it so much better now. So probably was a positive net.
Yeah, I see. And do you see, just as a second question, a chance for further consolidation in the industry, or it's perhaps not viable due to these competitive reasons?
Well, in Brazil, there is not going to be any merger-driven consolidation. I don't think the anti-monopoly authorities are going to let you acquire either Movida, which is number 2, or Unidas, which is number 3. So I think what you're going to have to do, you're just going to have to consolidate the industry by using superior customer service. Like how much bigger can you be? Like you're at 40% now in Brazil, maybe you're going to get to 50. It's not going to be a lot. I think in Brazil, most of the growth is probably going to come from just the market itself growing, because like I said, the penetration rate in Brazil is like 50% of that of the developed markets. But a much bigger growth driver for them will be Mexico. It's a super attractive market. In Mexico, they only have like 250 cars per 1 million population versus 7,000 in the US. And in that market, Localiza has only 4% market share. And also in that market, if you compare sort of the competitive standing of Localiza versus any of the competitors, that like gap is much wider compared to Brazil. Because in Brazil, like I think they have 90 NPS of 90, and the competition in Brazil has NPS of maybe like 65 to 70. The NPS scores for their competition in Mexico is probably 40 to 50. So it should be much easier for them to grow in in Mexico than in Brazil. And it's a great market for them because they have certain expertise of operating in a harsh business climate, and none of the competitors have that expertise. Like I talked to Enterprise, they don't even want to be in Mexico because they're saying, look, it's a harsh business climate. But for Localiza, it's no problem because they have expertise of running a business in Brazil, which is just as harsh as Mexico. So, I think Mexico might be a bigger market for them than Brazil eventually because in Brazil, I think there are 5 million tourists, and in Mexico, there are 15 million tourists. So, I would not be surprised that, 10, 20 years down the road, Mexico is actually, it's a bigger business for them than Brazil.
Great, thank you.
Thank you for the presentation. I used to work in a private equity firm that owned one of the largest car rental company in Europe.
Is it Europcar?
No, it was Goldcar, which actually was sold to Europcar.
Okay.
This is a quite risky business if you don't manage well. And this is a company that and I think has a reputation for managing very well the business. But the business has a huge operational and financial leverage. And I have a few questions. I tried to look at the investor presentation to see if I could have the answer, but 2 questions. One is, do you know, usually car rental companies have either they take all the fleet risk and they buy the fleet and they have the risk of movements in the price, or they get a deal with
an OEM and sell it back.
Yeah. Do you know the percentage of that?
Of course I do.
Okay.
They don't do it like that. I think in Europe, those companies do it. They have those repurchase agreements because they want to basically reduce that risk. However, with Localiza, they don't do it that way because they do so much volume of fleet that they're able to have their own dealer network. They have 250 dealerships across Brazil. So unlike smaller players, they don't need to do those repurchase deals. Because what you have to realize is that with the repurchase deal, you giving up probably 10% percentage points of the margin. And with Localiza, they don't sell at wholesale, they sell through the network at retail. So they get a 10% markup. And given the fact that they do so much more volume, they can afford to do it. Now, for a smaller guy, of course, you need a repurchase agreement to protect yourself. But with Localiza, given the scale, they don't need it.
So they go 100%
100% is going to be internal. Yeah.
Okay. And the second one is, do you know how is their sales or their income bookings distributed by direct or agencies or internet online players, etc.?
I think it's 65% direct and 35% online agencies.
Okay. And the last question is, I think the ownership structure was quite not concentrated, isn't it? So there is not a major shareholder, isn't it?
Well, there is not a major shareholder per se, but like I said, Eugenio Matar, who is the founder and also the chairman, or a founder, I should say, he owns 5%, so he's one of the largest shareholders. So he does provide that sort of owner mentality.
And is there any there any rumors in the past about takeovers or something like that? I'm saying this because this is an industry that has been along the way owned by car manufacturers, and they dispose it. And for example, Volkswagen acquired Europcar again. So just to understand, given the situation between car manufacturers, China, Europe, US, if there has been any rumors in the past, because it is a large market for car manufacturers. So I could see the point that a car manufacturer ends up acquiring a company like Localiza, just to understand if there has been any rumor in the past.
I have not heard any of those rumors, and I think that sort of car ownership is more of a European, North American phenomenon. In the emerging markets, those car rental companies, they kind of sprung up on their own, so there was never any link to the OEM. Have not heard of any such rumors with respect to Localiza. I know there have been rumors about Localiza potentially being taken out by the likes of Enterprise, but I talked to the company and said, look, if we get a good bid, we're happy to sell, but a good bid, they just said, look, it's got to be 20 times earnings. Unless it's less than that, we're not selling.
Okay, thank you very much.
Hi, to the right again. Hi. Are they planning to go into any new geographies?
At this point, no. I think they have their hands full in with Mexico. So, and like I said, in Mexico, it's such a vast market. Your penetration rate is 3.5%, and you only have 4% of that 3.5%. So there is really no need for you right now to go anywhere else. Now they do have presence like in Chile and Colombia and such, but they do it through franchise, so it's not like a proper market for them. So I think as of right now, they're just going to stick with Brazil and Mexico. I'd say in the next 5 years, for sure, you're not going to see them going anywhere else.
Perfect, thank you.
Hi. Just a quick question on the cash flows. They seem to be negative free cash flow every single year for the last 10 years, and I guess that's the fleet growth. So is there some point in the future where we're going to be saturated in the market and we'll actually see some cash flow? Or is it just going to be continuously doing that? And it looks like the way they fund it is by issuing equity. They seem to issue equity every single year, at least on FactSet numbers. It doesn't look like it was like a one-off time. It's like 40% higher in the past 5 years.
Yeah, I think when you talk about free cash flow with respect to car rental companies, it gets very tricky. If you just look at like Bloomberg or CapIQ or FactSet, like that free cash flow figure that you see is not really real kind of free cash flow. I think what you have to do, and like it takes quite a bit of work, you just have to recalculate, and basically for your CapEx, you should be using the maintenance fleet reinvestment rather than putting up new fleet. So if your definition of free cash flow is whatever operating cash flow you generate minus maintenance fleet reinvestment, like they actually generated a lot of free cash flow.
Well, that's my question is there some point where they're going to be saturated and not have to continually grow?
Well, I hope not. I hope not, because like I said, you hope that they'll be able to apply their superior ROIC to like a very large base of capital. So with them going into Mexico, it's probably going to be more than you've seen in the past, because obviously the company is much larger now, so they have fewer reinvestment opportunities, but driven by a few factors. Number one, like right now, I think they're going to be cash flowing more because the rental yields are not as attractive, and therefore they're saying there is no point for us in kind of keeping the foot to the floor in terms of buying new cars. To the extent that the rental yields get better, they'll be buying more of them. At the end of the day, I think it's all driven by saying what kind of ROIC can I get on the incremental car investment. To the extent that they see incremental growth opportunities, they'll be buying up more cars, and that's going to use up the cash flow. So to answer your question, I think in the foreseeable future, they'll probably be plowing more of that cash back into buying new vehicles as they expand in Mexico. So that'd be the answer. But probably I'd say less so than in the past.
Okay, and the share issuance every year? Like they pay a dividend, but they're issuing shares to pay for it, looks like.
Well, I don't think they did it every year. The last time they did it because, again, like I alluded to before, they look at the rental yields versus the stock earnings yield. And at the time of the last issuance, what they saw is that the yield on the stock price was way below the yield on the fleet, and that's why they did an equity offering.
Okay.
And now
the fact that it's every single year, like consistently through history.
Yeah, like
and adding shares counts. So.
Yeah, I don't think that's the case, because like I think they did a big one a couple of years ago, but they haven't done anything recently. They've been buying back stock.
Okay. And then just on the business, they issue U.S. dollar debt, and they're paid in reais. So just why you said there's no, I mean, in a recession, I guess they're not going to be able to jack up prices to offset that. So there is a bit of risk in that. Just one last comment is, before I pass it over. I don't think Uber is a threat at all, but Uber in Brazil is the cheapest thing you've ever seen in your life. There's definitely no depreciation of car values or anything in this calculation. So I don't think it's like I said, when you rent a car in Brazil versus taking an Uber, I don't think it's competitive at all. But just Brazil, Uber, ridiculous.
Yeah, but you know what? Just you raise a good point. Like you talk about what happens in the recession, and when it comes to car rental business, what you have to realize is that it's a business that is very countercyclical. Because when the economy is in the upcycle, that's where you're buying a lot of cars, and so that's where like your cash flow dries up a bit. But when the economy is actually in a down cycle, there is less demand for rental vehicles, so you will be paring back the fleet. and as a result of that, your cash flows actually goes up during the recession. So that provides this natural cushion against sort of your debt obligations. But with Uber, it's funny enough, speaking of Uber, so Localiza is the largest partner for Uber in Brazil. So they get most of their vehicles through Localiza.
Last question.
All right, thank you. I actually wanted to ask about the user case, and you actually just mentioned Uber. So what is a typical customer of the business? Like, is it a tourist, a foreign tourist, a local? And is there a case for like maybe SMEs or entrepreneur, like contractors hiring more, renting these cars more? And have they considered in going into more like subscription-based or like longer rental? Or and lastly, maybe are there significant is there a significant portion of customers who have low credit rating and so they cannot afford to buy a car, so they rent a car, but then they fail to pay, and so there is a credit risk in the business? Yeah.
Okay, so in terms of the breakdown between different customer groups, I can tell you that half the business is actually what you would call subscription. They call it fleet management, and essentially what it is, it's a long-term car rental. So you're going to have a larger organization that needs, let's say, 500 cars. So as opposed to just buying them, they go to Localiza and say, look, we need 500 cars. Can we rent them from you for, let's say, 3 years? And it's a long-term recurring revenue contract, so it's guaranteed revenue for you. So that's about half the business. The second half, which is shorter-term car rentals, some of it is tourists. Some of it is going to be just business people who are doing business trips, and some of that is replacement for vehicles that have been in an accident and currently being repaired. So like there's an insurance incident, and you need a vehicle replacement. So that's what you get. As far as the dynamic whereby people cannot afford to buy a car and they rent instead. I really don't have the data, but I don't imagine it's a lot because, if you need a vehicle to drive every day, a rental is just not a great option. Like it's going to be pretty pricey, right? Yeah, but it's not like you get the invoice post rental. Like you provide a credit card and they charge you up front, right? So like, where would be the credit risk?
Okay. Thank you so much, Pavel.
Sure.